Which of the issues around Lyft should investors think about the most? I mean, we've been talking about governance, we've been talking about competition, we've been talking about valuation. There's potential regulatory issues. What's the focus?
Well, the dual class issue, lots of relevant and very important discussion about that, John. But let's be real. If you don't want to buy the stock because of that, and that's a very fair reason, do not buy the stock. Right?
But Uber doesn't have the same issue, and they're bigger.
Then you may well wait for Uber. But I would just, so that's on the governance side. On the operational side, I looked at one sort of thing that really caught my eye this morning. What do you think the property, plant, and equipment is of Lyft? $121 million. $121 million. What do you think the PP&E is of Ford Motor Company? $68 billion. So there are lots of questions you can have about the pricing, the marketing spend, everything that's going into keeping the profits down at Lyft. But when you look at the true leverage of a software-enabled business like Lyft versus a physical molecules-enabled business like Ford, you start to see something that really is, I think, largely about the future.
It's the asset-light model that's so attractive at this point.
I mean, you don't own a car, you don't own a medallion, you don't own the drivers. So those, to me, from an investment standpoint, are positive.
But for many, many businesses, one of the biggest costs is labor. And the same is true for Lyft. I mean, labor is what they pay drivers, what they pay in marketing expenses. And investors seem to be bifurcating the story into a short-term story in terms of the massive amounts of money that they're losing right now versus the longer-term story, which is the autonomous story, which a lot of people want to believe in and say, if you can buy Lyft today and put it in a drawer for 5 years, maybe this is the investment for you.
If anyone is buying it based on autonomous, I would say go back and rethink it. It is so far out there. What's going to drive the stock over the next couple of years is the quarterly performance. Can they sustain this growth rate? Can they make it so the losses continue to narrow? If they can, and the stock doesn't trade up instantly to 90 or 100, then I think you can see why big institutions are getting into it around the IPO price. But go back to John's question, the big issue is valuation, is how much it's worth. People have been wrong about these companies from day one. So many people saying, oh, Uber's such a stupid idea, the valuation's ridiculous, Lyft can never make it work because it's a network game, there's only going to be one. All those folks, entirely wrong. All the metrics here, with the exception of the bottom line, look great. They're improving on all of them. But at $88, if that's where it opens, you're looking at a stock that's trading at about 10 times this year's revenue with a margin structure that is nothing like Facebook or Microsoft or a lot of other tech companies, probably has a 50% gross margin at best. So you have to worry about that multiple.
Which, Dennis, I think begs the question, what is the path to profitability for Lyft? And how much does that hinge on autonomous vehicles? And the fact that they've bet on a model that's very different from their chief rival who will also go public.
Right, I think Henry's got a good point, right? So now that you're a public company, right, you are going to be measured by that quarterly performance. But interestingly, as you become a public company, in a way, you have levers that you can pull and a market expectation that is different than it was before. Yes, growth is going to matter immensely. But I think you move more towards an airline pricing model. Isn't it ironic that when Delta drops a fare, United drops a fare, Delta raises a fare, United raises a fare? I see that sort of kind of unspoken sort of market dynamic where prices probably will come up over time and the margins will probably improve over time too. That seems to me the natural path of things.
Henry, the flip side of the asset-light advantage is perhaps the lack of a moat. I mean, the same language was used around Amazon versus eBay back when they went public. Boy, eBay has the perfect model. They don't ever have to touch the stuff. People ship it themselves. Amazon spending all this money on warehouses. Isn't that awful? Well, it turned out it wasn't that awful. So how important is it that the assets are light? How closely should investors be looking for differentiation that's going to provide Lyft a path to some kind of leverage down the line?
I think there are a lot of assets here that are just intangible. Having everybody know Lyft, they talk in the prospectus about how more and more of their downloads are coming just from organic. People hear about it, they want to use it. The technology is incredibly complex. You have to be big. There are huge economies of scale. They're all now, both Uber and Lyft are getting into the scooters and the bikes, and it's really hard to manage all that. So I actually do think there is a real asset being built here. I think the other thing that people miss on the losses, and this has been the story with Uber all along in the private markets, is these companies continue to have both mature markets where they've been forever, and the story with Uber a few years ago was those markets are wildly profitable. Then they continue to roll out new markets where they're losing a ton of money. And my guess is, Lyft doesn't disclose any of this, but my guess is that a lot of the losses are coming from markets that are new, that are losing a lot of money, and that the core markets are probably profitable. And that ultimately that is how they will get to profitability.
Are we
if they get
fixated at this point in time in the IPO process? I mean, the thing hasn't even traded yet on the path to profitability. I mean, should we look at an Amazon and say, you know what, we didn't know what the path to profitability was, but if you had invested at the IPO, you'd be very happy today. I mean, there's a difference, right, between looking at the company and the path to profitability versus the return on a stock investment.
I think it's a great point that today the fact that they're losing a lot of money is actually not necessarily relevant to ultimately whether they will make a lot of money as long as they have the right
when you're looking at the revenue doubling in the past year.
Absolutely is relevant to valuation. You have to have a story in your mind that says, okay, if they get to 5, 7, 10 billion in revenue, how much profit are they going to drive? Ultimately, this stock, like all stocks, including Tesla and other cult stocks, are going to be valued on cash flow, period. And the multiple will compress a lot. So if you can't tell yourself a story of how they get to that, ultimately you're exposing yourself to getting clobbered.